Talk about some of the companies though. Let's start with Berkshire Hathaway. What's that? That's Warren Buffett's mega conglomerate over in the United States, northwards of $300 billion worth of market capitalization. The reason we mention it here is that right at the core of Berkshire Hathaway is a company called Geico, which is one of the US market's largest auto and other property and I think, incidental business insurers. So they use the float, which is exactly what you're talking about, to buy all those things, as Warren has done over the years. Metrics, yes, $356.88 billion. That's huge. Price to earnings ratio 14.63, and he doesn't pay dividends. Sorry for you, no dividends from Berkshire Hathaway. But the business itself, really, that was the engine that he used to build the incredibly successful group that we see today.
Yes, so he is considered the founder of this philosophy of using the free float to make non-insurance investments. He's got a substantial insurance business. Geico is a direct insurer, pretty much to South Africa's direct insurers. And then they have a big reinsurance business inside that as
that
well.
Too. That's worth pointing out.
General Re, which actually generates a substantial amount of free float.
This is a quick aside. Reinsurance is where insurers pass on elements of the risk to outside bigger players at the back end.
Yes, correct. So it's the insurer of the insurer. That's why it's called reinsurance.
But how does he get away with it? I suppose the assumption is that he's got as much time as he needs, and he uses that to buy businesses, like they recently bought Precision Cast Parts, which is a massive industrial business, which he just thinks is fundamentally undervalued, and over time it just gets larger and larger and larger.
So he's used all that capital, and as you said, they don't pay a dividend, and they never have in their sort of 60 years as he's been the controlling shareholder. So it's a true total return business, and something like when he bought in, it was $19, and now the share price is, $260,000 or something like that.
That's the B units, I think, or the A units.
The A units and the B are 100th of that or whatever. So it's been an incredible growth story, and most probably one of the most successful investors of all time.
Because, of course, he is an incredible value finder, and as a result, he has bought into businesses that have done exceptionally well, and there's an enormous portfolio going on there. Okay, we'll get back to the insurance theme in a minute, but with offshore funds, would you consider a Berkshire Hathaway holding perhaps of the B units to be a good idea? The guy is not any spring chicken, right? Him and his partner, Charlie Munger, are getting pretty ancient. What happens if in the aftermath, if he's no longer there, the whole thing comes apart? Would that necessarily be a bad thing?
That is a risk, because they've been quite secretive about the succession issue. And they say they've identified someone, and there's no issue if he had to drop dead tomorrow. He's 85, by the way. It would be seamless. That is uncertainty, but I think he has really got a very, very strong management team in place. And Ajit Jain, who's the head of the reinsurance operations, he most probably
the
will
crown
be the
prince, although there's guys like Todd Coombs. I've just been reminded we haven't looked at the share chart. So there you can see it sort of follows the market. It's had good years and bad years. 2015 wasn't a tremendous one, but it has done reasonably well here in 2016. So just give us a quick hot or not. You like it?
Yes, I do like it.
I'm going to go not hot. I just think, like you can do better yourself directly. But anyway, hold that thought.